Hey, so the Fed has cut rates twice now, but mortgage rates will not go down. So what's going on? Hey, welcome to this week's Mortgage Minutes with Mitch. I'm Mitch Jenkins, Senior Loan Officer with Your Home Financials. So first we're going to take a look at a couple headlines this week, and I will start with the Consumer Price Index. So one of the measures of inflation came in pretty much right on target. No real surprises there. However, a trend emerged, and that's a little bit concerning. So if you look at the 6-month average, we're at about 2.5% inflation. Remember, the target's 2. But if you look at the 3-month average, that's 3.5%. So we're running a little bit hot the shorter the window, just showing that inflation might be starting to curve back up, at least in the short term. Now, retail sales was another hot topic this week, and they came in showing minus 0.1. The expectation was a positive 0.3, so that's a hit right there, showing that retail sales are down. But the surprise was in the revision to the prior month. So last month it was pretty hot at 0.7, but they revised it up to 1.2. So retail sales, even though they were weak this month, were hotter than reported the prior month. So that kind of negated that, and unfortunately was not good news for mortgage rates. So that brings us to what's going on. Why have they not come down? Well, try to keep it simple, but when it comes to investing, you have options, and the bond market is one of those options compared to the stock market. Now, the bond market is kind of like the tortoise, and the stock market we'll call the hare. So the bond market is where mortgage-backed securities are traded. Now, that's basically if a mortgage company writes a bunch of mortgages, they group them all together and then sell them off as mortgage-backed securities. So investors can purchase those and ultimately make money on them for your, maybe your 401k. So what happens is those are slow and steady returns, whereas the stock market can be a huge spike, but also a very big risk. So with the bond market, it's kind of a slow and steady investment that is guaranteed return as long as people pay the mortgages. Now, the stock market could go either way, and that's where investors right now are pouring all their money in, because the bond market is just not as attractive as the stock market. So you might call that the Trump effect, as some people have coined it. Since the election, stock markets are all going up. Now, they've come down off of some of the record highs, but even still, the Dow's up 300, the Nasdaq's up 400, the S&P's up about 170 when I checked this morning. It was actually up over 300, but that's come down a little bit. Regardless, since the election, huge increase in the stock market. So all that money's flowing out of the bond market into stocks because people want to make their money there. And unfortunately, that drives the demand down. Therefore, the bonds have to keep mortgage rates up higher to keep them even remotely attractive to investors. So at this point in time, with the market being as hot as it is, and a lot of the policies that people are expecting Trump to implement when he takes office being inflationary, unfortunately, we don't expect mortgage rates to drop anytime soon, even if the Fed were to reduce rates again in December. So, all eyes are going to be on the two big reports still to come. We have the Personal Consumption Expenditures Report. That's going to be out November 27th. And then you have the next job report, which is going to be out December 6th. So both of those could have a huge impact on what the Fed does December 18th, because it's not a guarantee that they're going to cut rates again at the next Federal Open Market Committee meeting. So that's the latest. If you are interested in looking into buying a home, would love the opportunity to work with you. Let me know what I can do. So as always, thanks for watching, and we'll see you next week.